Since last year, Euro Central Bank announced to do the QE for stimulate Euro economy, and recently ECB seems want to expand monthly purchases by 20 billion from April. Is it benefit for the bond market as ECB prepare QE boost? And today we are glad to have expert Donald Amstad here. He's Director of Business Development in Aberdeen Management, and he's from England, based in Singapore. Hello, Donald.
Hi there. Thank you very much for having me on your program today.
Yeah, Donald, could you tell our investor who has already holding corporate bond, the ECB policy may provide boost?
Absolutely. Mr. Draghi, I think it's fair to say he disappointed the markets in 2015.
Yes.
And with Europe sliding into deflation in 2016, at the first meeting, Mr. Draghi had to surprise the markets. And the big surprise in his stimulus package that was announced a couple of weeks ago was the decision to buy corporate bonds in the QE program as well. And as a result of that announcement, even before they buy any bonds, we've seen a dramatic collapse in corporate bond yields. So as yields come down, prices go up.
Yes.
So for investors in corporate bonds in Europe, this is very good news because the price of their assets has gone up, and it's been taken very well by the market, also by the equity market. And of course, it's also very good news for the Euro high yield market, as the ECB is only going to buy investment grade bonds. But as investment grade yields come down, then people may move out to pick up more yield to go into the high yield part of the market as well.
Then we mentioned about the QE, then what about the negative interest rate? Because is it benefit for the bond holder? I mean, QE and plus the negative interest rate, and how to adjust the investor's portfolio. Like for them, they should hold more bonds in their hand, or how to allocate.
I think the move towards negative interest rates is slightly more controversial. It is theoretically helpful because it will encourage risk takers supposedly to extend duration and to take more risk and to buy bonds. So I think that should help. The only problem is that when you move to a world of negative interest rates, it does impact the profitability of the banking sector. And one of our concerns in Europe is that the banking sector is very fragmented. I mean, for example, there is no such thing as a European bank. There are Greek banks and Italian banks and Spanish banks and Austrian banks and Dutch banks and French banks and German banks, but there's no such thing as a European bank. And therefore, rather similar to Taiwan, in fact, some people say that Taiwan is overbanked. There are too many banks in Taiwan.
Yeah.
There are too many banks in Europe, and it means that they're all fighting for their own piece of the pie. It means that the profitability of the industry already is quite low. And this move to negative interest rates is going to further erode net interest margins for the banking system. And so actually the reaction of, for example, bank share prices has been rather more muted because people see this move to negative interest rates as impacting the profitability of the banking system. So although when you take QE plus negative interest rates, I think it's very good news for the holders of corporate bonds, whether it's investment grade or high yield, and probably for most company share prices. I think there is a question mark still over the impact it's going to have on the banking system, and I think the impact on the banking system is not as positive. It's probably still a net positive, but not as big a net positive as it is for the corporate bond market.
Okay, then what about the Fed? If they rate hike 3 times this year, what's the impact, and how to react, how to respond?
Yeah. Well, a couple of weeks ago, the Fed were still saying that they were going to raise rates 4 times.
Yes.
And then Mrs. Yellen came out and showed us the new dots. And now the view of the Fed is probably that there are going to be 2 more rate hikes this year. I think if we go back to 3, then that's going to probably be good news for the economy, but probably slightly negative news for financial markets. And certainly, when you look at the market reaction to the decision to try and raise rates 2 times rather than 4 times, the reaction was very, very positive from a risk-on point of view. Risk assets since then have been quite strong. So if they start creeping back to 3 or maybe back to 4 again, then probably the markets are going to take it slightly negatively.
Okay, then for the fund manager, how they going to respond? How any the action they will take, or they will maybe hold more bonds when the price is low?
Actually, I think our view, particularly when it comes to Euro high yield at the moment, is that when it comes to taking interest rate risk or duration risk, that for us is not very attractive because yield curves are quite flat at the moment. We would much rather take credit risk instead. So in our portfolios, we're typically running short duration versus the benchmark, but we are overweight in our Euro high yield fund. We're overweight single Bs rather than double Bs. And then within terms of sectors, we are very underweight European bank bonds because of the reasons I mentioned earlier. And then from a country perspective, we have a big underweight to the periphery economies of Europe. That's Portugal, Italy, Ireland, Greece, and Spain, and an overweight to the UK, because when you're lending money to a highly leveraged company, what you want is strong nominal GDP growth.
Yes.
And when we look at the European economic area at the moment, probably the strongest growth we're seeing is in the UK.
UK or Germany?
UK or Germany, but actually particularly the UK.
Okay.
So we have lent quite a bit of money to companies in the UK, and we're overweight the UK and underweight the slower growing economies like Portugal, Italy, Ireland, Greece, and Spain.
Okay, then you mentioned about the UK. Then if the Brexit happened, the sterling might get weakened, right? Then
that's
how
correct.
To react the currency exchange loose?
Yes. No, the vote in the UK will take place in June to decide whether or not the UK stays in the European Union or decides to leave. And the volatility we're seeing at the moment is very much in the currency markets. So whenever we buy sterling denominated assets for our Euro high yield fund, we always hedge the currency back into euros. So we don't take any currency risk in our Euro high yield fund. So far, the stock market in London and the corporate bond market in the UK has not been volatile because of fears of Brexit. And actually, our hope is that volatility in the corporate bond market does increase, because if volatility does increase and prices fall, then we have a shopping list of companies whose bonds we would like to buy in case there is a sell-off, in case the UK decides to vote goodbye.
Then we mentioned about Brexit, and what about the terror attack? Because as we know, it just happened in Belgium. Because Morgan Stanley, they have a report, they alarm the investor because the terror attack might affect the Euro's economy recover, right? So what do you think about this?
Yeah, I think it's very fair. I mean, I happened to be in Paris last year at about the time of the terror attacks, and you could see the fear in people's faces, and it's going to mean that people are not confident to
walking
to go
on the
out
street or go out.
or to go and consume or anything like that. And it's something that is there, and it's always at the back of people's minds. And so we had Paris last year, and then just recently Brussels, and a couple of years ago we had the terror attacks in London. And yes, I think that's going to be a dampener for the Eurozone economy. So it probably means that the ECB needs to continue with its stimulative policy to try and give confidence to financial markets, even if consumers are feeling understandably a little bit afraid.
Yeah, people get job, they won't do something like attacking people because you have something to do.
Yes, exactly.
But if you have nothing to do, you're just getting crazy.
Yes,
maybe.
yeah.
Okay, and for the Euro high yield bond investor, do you think how much portion they should hold in their asset, like maybe 60% in this Euro high yield bond fund, or how many percentage they should, or for maybe for like young investors or for old investors, for different investors, how to for them, do you think this kind of product is good for what kind of investor?
Sure. Well, the Aberdeen Select Euro High Yield Bond Fund is a fund that tries to pay out income on a monthly basis. So I think it's very suitable for people who need some sort of a monthly income. And we do have a share class that pays out monthly if you need monthly income, if you're maybe a more elderly person or a pensioner. But then if you're a younger person, then we have a share class that reinvests the monthly dividend. So it doesn't matter really whether you're young or old. I think you can make some allocation to Euro high yield. And one reason why we particularly like Euro high yield as an asset class is, first of all, compared to European equities, if you look at historical data over the last 10 years, the returns of Euro high yield have been roughly twice or double the returns of European equities. And the volatility is about 2/3 the level of European equities. So double the return for 1/3 less volatility on a risk-adjusted basis seems very good.
So you mean it's a low risk and a high return?
Yeah, compared to equity, compared to European equities historically. And then when we compare European high yield to US high yield, we think that European high yield looks quite attractive because in the European high yield market, there are very few bonds issued by energy and oil exploration and production companies. So in the US, roughly 10% of the market is bonds issued by these E&P companies. And the price of these bonds really just depends on the oil price. If the oil price goes up, then these bond prices will go up. If the oil price goes down, then these bond prices will go down. And we don't have that same exposure in Europe. So I think compared to US high yield, European high yield will be less volatile for that reason. And then secondly, when we compare the Federal Reserve with the ECB, the Federal Reserve has stopped QE, and as you mentioned earlier, is trying to raise interest rates, whereas on the other hand, the ECB is lowering interest rates even further into negative territory and is expanding its QE program to include corporates. So when we look forward over the next 6 or 12 months, we think that Euro high yield, the index is yielding about 5.5% in euros at the moment. So if you hedge that into dollars, you can probably earn about 6.5% in US dollars. We think that's quite a reasonable rate of return for the risks you take. And we think that Euro high yield over the next 6 to 12 months will be a relatively low volatility asset class. And if you take a company like Volkswagen last year, they had the terrible corporate news. The Volkswagen share price fell by 30% on the news. The price of Volkswagen 5-year bonds fell by 4 or 5 points. A very, very small fall compared to the fall in the equity market. So, if you're uncertain about the outlook, it's difficult to say what percentage because I don't know what's in people's portfolios. But we certainly think that Euro high yield is an asset class that people should consider, and probably consider ahead of US high yield and ahead of European equities.
And you mentioned about the like Volkswagen, and we're talking about what about the default risk? Because
Sure.
I saw the fact sheet. Maybe you have maybe some 1.30% in investing in the South Africa company and Croatia. And some this kind of emerging market is default rate or default risk is higher. I mean, if any default happened, how is it happened before or
Sure.
Yeah.
Well, the default rate in Europe at the moment is about 3%, which is relatively low, and we expect the default rate in Europe to continue at about 3% this year, which compares to the United States, where the default rate is going up, and the default rate in the United States, in the US high yield market this year, will probably hit about 6%, we think. And that's because mainly of what's going on in the energy sector with these oil and gas exploration and production companies. So when you compare the expected default rate in Euro high yield compared to US high yield, probably about half the level. In terms of the Aberdeen Fund and the companies we invest in, we do a lot of intensive credit research before we invest in any particular company. And in terms of Aberdeen's credentials, our success, if you take 2015, for example, in 2015 in the Euro High Yield Index, there were 90 issuers of bonds that had a negative total return last year. And Aberdeen only owned 10 of those 90 names. So I think the Aberdeen investment process and the Aberdeen investment team is very skillful at trying to not so much pick winners as avoid losers. When you're taking credit risk, because a bond will always mature at 100 or par, it's not like equities. In equities, theoretically at least, a share price can go up forever and ever. If you buy a share at 1 cent, it could go to $100. But when you buy a bond, you typically buy it at about 100 or par. And if you're lucky, you get your money back in 5 years' time or 10 years' time. You get 100 back. And so the trick or the skill that you need when you're investing in a high yield fund is to try and find a manager not that can get the upside, but that can avoid the downside. And it's all about avoiding the losers rather than picking the winners. And I think Aberdeen is very skillful in the Euro high yield team that we have in avoiding the losers.
Could you tell our investor the characteristics of the Euro high yield bond? Because we didn't introduce your product at the beginning. We can add it afterward.
Well, I think many of your listeners will probably be familiar with the US high yield market, which is a $1.3 trillion bond market. And I know that several of Aberdeen's competitors have had US high yield funds that have sold very successfully over the years into the Taiwan market. So let me compare the European high yield market to the US high yield market. And there are two important differences. First of all is the risk in European high yield is a lot less than the risk in US high yield. And that's because on average, the bonds issued in European high yield market are double B rated, whereas the bonds issued in the US high yield market are single B rated. So the credit risk in Europe is a lot lower than it is in the United States. Secondly, when it comes to interest rate risk or duration risk, the duration of the European market is about 3.5 years, and the duration of the US market is about 4.5 years.
It's longer.
Is longer. So US high yield from a duration point of view is also more risky compared to the European high yield market.
But the duration longer, the interest rate, the coupon is higher, right?
Yes, that's right. So at the moment, you have a situation where the US high yield market yields maybe 8.5%, whereas the Euro high yield market only yields 3.5%. Sorry, 5.5%. So US high yield yields 3% more. So I think many investors will say, oh my goodness me, the yield on Euro high yield is very low and not attractive, and therefore I want to go and buy US high yield. But I think you have to understand and try and make a decision as to what is the fair value between US high yield and European high yield. And of course, one difference is that European high yield trades at a spread over the 5-year German government bond. And US high yield trades at a spread over the 5-year US Treasury, US government bond. Now, the difference in yield between the US government bond, 5-year, and the German government bond, 5-year, is about 170 basis points at the moment. So you would expect US high yield to yield about 170 basis points more, just because one trades off US Treasuries, the other trades off 5-year Germany. Then, as I mentioned earlier, we have a situation where US high yield is more risky because it's lower credit quality and longer duration. And we think that if you take more duration risk and more credit risk, you should be paid more for that. And we think that's worth probably about another 130 basis points. So already you've explained the 3% interest rate differential. And then when you further consider the US high yield market, the fact is the reason why the yield on the US high yield market is so high is because 10% of the market is trading at a distressed level. These energy bonds are trading at yields of about 15%. So you have 10% of the market yielding 15%, and then actually the other 90% of the market has a much more normal level of interest rates. So when we try and do like an apples for apples comparison, trying to allow for the fact that the US high yield is riskier, it has all these energy bonds in it, and it trades off US Treasuries, actually we think that European high yield is probably slightly cheap to US high yield if you're making an apples for apples comparison. So yeah, sure, you can look at the yield of US high yield, but don't be fooled by looking at the headline number. Try and understand what goes into making that yield. And then when we look forward and we try and think about volatility, as I mentioned earlier, because the Fed is trying to raise rates and has stopped QE, whereas the ECB is cutting rates and increasing QE,
so
we think that looking forward, Euro high yield would be
more volatility.
Euro will be less volatile, and US will be much more volatile. And obviously,
I mean, the liquidity in Europe is more.
Actually, I think on a liquidity basis, the US market is 3 to 4 times the size of the European market. So I think the US market would win on a liquidity point of view. But of course, liquidity is not consistent across the market, and there is about 10% of the US high yield market is trading at distressed valuations at the moment, and in that distressed sector, liquidity is not so good compared to the less distressed sector. So liquidity is not a given, but we have plenty of liquidity in the Euro high yield market for the names we trade.
So it's not a problem.
Not a problem at the moment. Yeah.
Okay, because many investors, they concerned about if you buy a bond, they have a monthly coupon. You get a monthly dividend, but some fund you get a dividend, but it's from the capital you invest.
Yes.
So this kind of situation is it occurred often occurred, or it's just sometimes just happen?
Yeah. Well, I think whenever you buy a fund or a financial product that guarantees a certain level of income Maybe it's 4% or 6% or 8%. I think there's one product in the market at the moment that's even trying to guarantee 9%. You have to be very careful about where does this income come from. And some fund houses are very open about the fact that if they cannot generate the income from coupons in the fund or capital gains, then they will pay that monthly income or monthly dividend out of capital. Aberdeen, I think, is very different to many of our competitors because we do not guarantee income on any of our products, and we do not pay out of capital. Now, our Euro High Yield Fund does pay a monthly dividend, but that dividend is only paid out of realized capital gains in the fund or coupon income that we receive, and we don't guarantee a certain level of income every month.
I think we no more questions. Yeah, we're done then. So, thank you, Donna. We really like to see you here.
Thank you very much, Lee, for having me. And,
thank you.
I wish your readers and your viewers all the very best for the rest of 2016. Thank you for having Aberdeen on your program.
Thank you.
Okay, thank you. 谢谢。
谢谢。好 ，OK。